Hello everyone and welcome back. My name is Greg Furman and this is the Forex Weekly Outlook for the week of June the 10th, 2019. Now, to get started this week, we're going to begin where we always do with that very important US dollar index. Now, with the dollar index, you can see that we've had a pretty substantial sell-off. Now, the dollar is normally weak during the course of the end of the first week of the new month. Usually that's when the dollar is at its weakest. I'm not convinced that at this time that the dollar is just going to sell off. You can see that basically here, that I'll outline this for everybody, that we're largely still within the overall broader range. The dollar's still very much positive on the year, so I don't think the dollar may be down, but I don't think it's out just yet. Now, when we identify this range that we're in, we can see that we've got some very strong support sitting at the lower 95.85 area and more significant support coming in towards the 94.65 area. I would say, in my respectful opinion, that if we can break through this support at 95.84, then we are going to go lower, but I do also anticipate the lower end of that range to hold. Now, when we look at the VantagePoint indicators, we can see that the predicted differences and the predicted RSI at 12.3 are already becoming oversold. Now, our key pivot area on the upside for this week, 96.83. If we can retake that level, the dollar will recover, but I don't anticipate that that's going to happen, knowing the normal dollar cycles being weak in the middle of the month, strong at the end of the month. Now, how this is affecting gold right now, we can see that gold has made a big push up. The one thing I will point out very clearly here, guys, when we're talking about the non-farm payroll number on Friday, I know that a number of analysts and pundits are saying what a horrible number it was. In actual fact here, guys, it wasn't really that bad. Now, what I mean specifically by that, if we look at our U6 number here, we can see that during the course of so far in 2019, one time about a year ago in 2018, we hit 7.3 million, but you can see that March and April and February actually were at 7.3 million. Now the U6 number measures the broader unemployment. That's basically the total unemployment plus all persons marginally attached to the labor force. So we're looking at the broader unemployment, not just that U3 number. So we've gone from 7.3 million to 7.1. That is an excellent number, guys. Let's not lose sight of that. That's 200,000 more people going into the market, not out. The U3 number is a survey headline number that's basically revised up and down and all over the place, but the U6 is not revised. So when I look at that, gold has made a big push to the upside. Now, as I'm doing this presentation, it's my understanding that a deal has come on the US-Mexican tariffs. That's another positive for the US dollar and probably a positive for the equity markets to start the week, which I'll talk about in a minute. But for now, what we look at here now is any kind of needle in the haystack that tells us something may not be what it appears to be. So when I look at this, our medium term crossing the long-term predicted difference is warning us that gold may not be as strong as what we actually think it is. So we should watch this level very, very closely. If we can't progress on gold and advance higher, then I feel we may have a problem here, and actually it may be gold that weakens. So as we back our chart out, we can see significant resistance at the 1361 area. So we want to be very cautious because essentially the VantagePoint software is warning us that we could be reversing here. The medium term crossing the long term predicted difference to the downside, plus we've got a heavily overbought RSI. Now our neural index is still positive, but if that neural index turns from green to red, we definitely want to start looking at shorts. Now, with the S&P 500, we've had a big push up, but once again, in my respectful opinion, only for all the wrong reasons here. Now, what I had talked about this week's in VantagePoint's live training room, we identified this major swing low down at the basically around the 27, 28, 27, 30 area. The market hit that verified zone in the VantagePoint software to the number and then rallied off that to where we are now. But now we have significant headwinds up top, all the way up to the 29.60 area. Now, again, with those tariffs now not being put onto Mexico, this should push the equity markets higher. But more specifically, the Fed once again interfering in the markets here, suggesting there's going to be multiple rate hike cuts in 2019. I am not in that camp in the least. The only thing I know about the Fed, guys, is they constantly get this stuff wrong. And 3 rate hikes when a U6 number is at a all-time low at 7.1. The additional numbers coming in, I don't disagree the economy is slowing a little bit, but 3 rate hikes, guys, that's a little much for me to swallow. So I'm not really on board as usual with the Fed, but again, we'll wait and see. But for now, this is where the equities are getting their fuel from. They're getting it from the Fed. They're getting it from, the potentially now the reversal in the tariffs. If I didn't know any better, I would actually think that somebody knew that that tariff was not going to be put on, and that's why they were buying these equity markets. But again, when we look at this, our medium term crossing our long term predicted difference off of that verified support level led to the rally where we are now. But remember, we've got significant resistance at 28.24 and of course 29.60. Now with oil is clearly following the move on the equity markets. As the equity markets recover, as I had talked about in last week's Forex Weekly Outlook, the direct intermarket correlation is to oil. So oil recovers if equities. So if equities turn back down, oil will follow. Right now, we're still, the main indicators in VantagePoint are pointing towards a corrective move towards our T-cross long at 57.13. So oil and equities, I think they have a chance of recovering next week. But once again, we have to see how the market reacts to the non-farm payroll number on Monday and to the fact that Mexico will not be getting those tariffs put on them. So this brings us to our first Forex pair, the Euro-US pair, the most heavily traded Forex pair in the market. We can see that we've taken out this major resistance level here. That level you can see has been identified and has been in place since early April. That area coming in at 13.23. We are closing just above this area, but guys, we have to be very, very cautious of a bull trap here. Now, what I mean by that specifically is that if gold reverses, the euro has a very high intermarket correlation, and if gold turns lower, the probability is the euro will follow. So right now we're coming up into a very strong level of resistance between 13.23 and this major level at 114.46. But again, the US dollar is usually weak at the end of the first week of the new month, so I would anticipate a little bit more strength, but be very careful up here. The indicators from VantagePoint already moving into overbought territory, yet still positive. But overall, once again, guys, remember, when you hear that the euro is trending or it's not trending, just remember, we're in a very identifiable range here. We have not traded outside of this range in the last 3 months. So until this range breaks, the euro is not in a trending move. Very important that we identify that. Also using the VantagePoint indicators warning us that this range is still likely to remain in place. Now, as we look at the Euro-US counterpart, the US Swiss franc, still moving lower, but we've got some heavy support down here. Right now, last week's big push down, after that recovery, we hit a low point of 98.54. We want to watch 98.54 to see if we can move it lower. Remember your direct intermarket correlation. If equities turn around, then it's very likely that even if the dollar is weak across the board, the dollar can make gains against the Swiss franc and the Japanese yen if we shift from a risk-off to a risk-on environment. So keep an eye on that, but to start the week, it is going to be dependent on what happens with the global stock markets. Now, looking at pound dollar coming into next week, the indicators from VantagePoint are warning that the pound dollar is getting ready to make a move. Now, the pound has been mirrored in conflict because of Brexit, Theresa May leaving office, a lot of different things. But the indicators are warming up. They are not overbought in the least. We just have to clear. We have just closed above the VantagePoint T-cross long at 127.28. We're closing 127.30. Not a huge move above, but we're looking to build on this. If we can take out this verified resistance zone by midweek, that area coming in at 128.10, that will open the door back towards the 131.76 high from May. So that is our target for next week on dollar weakness. The RSI still has plenty of room to move. The position of the predicted differences that are fully backed by the neural index, it looks like we have a decent opportunity here. Now, when we look at the individual crossovers, our short term is good, our medium term crossover is good, and we're clearing our long predicted, and we can see how the market is using that long predicted on a daily basis for the last 5 trading days as a pivot area. This is where the market participants are buying. That current level, 126.95, longs off the open on Sunday, are supported by this analysis. Now, with dollar yen has very, very significant support here, guys. Down as low as 107.75. We could see a reversal. Next week could be a very good opportunity for buying dollar yen. We've got a signal on the predicted differences. We've got this low support at 107.77. We could be moving into a risk-on environment that is an absolute positive for dollar yen and US Swiss franc, even as I said with dollar weakness. So watch that level around 107.75 or even the 108 level to round it out. If we can hold around this level, then the market should use this as a springboard to correct back to the T-cross long at 109.15. Now, looking at our 3 main commodity currencies, the CAD, unlike the US, did have a very strong labor report. But again, my argument is that labor report from the US was nowhere near as bad as some of these retail websites are suggesting. I actually thought it was a pretty decent number, even though the U3 was down. My argument is based around the U6 and that we're still range trading. When we look at the overall range on US Canada, there's an 80% probability that we're going to have order flow traders coming in down around this 132.50, entirely possible. But if we lose that level, that is likely going to open up the door to a much deeper move to the downside on this pair, potentially towards the 130 area. So keep that in mind. But right now, the indicators are, I feel that we need a corrective move first before if we make the next move, the next leg down, we need a corrective move first. That move would likely come on Tuesday, not on Monday. A lot of times with US Canada, it's a continuation from Friday's trade only to reverse on Tuesday. So keep that in mind, guys. Right now, the indicators from VantagePoint are moving into heavily oversold territory. 12.3 on the RSI. The predicted differences are moving into oversold also. So like I said, if nothing else, I feel we're going to get a corrective move back towards our long predicted at 133.81. So if we're looking at potential shorts, we would like to see the market move higher first. Now, with Aussie US and New Zealand US, once again here, guys, let's not lose sight of what the actual trading range is. When we look at the trading range here, nothing has changed. We're still within this range where we've been. We're at the lower side of that range. Now, when I look at this and I say, okay, we've got a fresh triple AMA cross, we've got good support at 69.59. The only downside that I see right now is we have formable resistance, and that starts at 70.47 and goes to the next level at 70.68. If we can break through 70.68 and close above that, then we've got a real shot of breaking back out to the upside. That's what we want to look at. Now, we've got, again, warning signs from the VantagePoint software. The medium term crossing the long predicted, the predicted RSI in heavily overbought territory. So we want to see if we can push through this resistance. But if we start failing around this 70.47, 70.68, then shorts will be back on the table. Now, our final commodity pair, very similar to Aussie US, New Zealand. New Zealand so far in the month of June, guys, is the strongest currency in the Forex pair. What a difference a couple of weeks makes, isn't it? Last month, the Aussie and the New Zealand together were down almost 16% against their G7 counterparts. They've managed to recover. They're moving higher, but again, we've got formidable resistance here. The first level that we must break through here, that high is coming in at 66.85. If we can get above that area, our next verified zone is not until 67, basically about the 68 mark. So right now, the New Zealand looks set to move, but again, a corrective move on a number of these currencies first certainly appears to be in the cards. Currencies don't just break out. What they do is they usually correct a little bit after they've made a significant move, which is what Aussie, the New Zealand, and the CAD have done. Once they have a corrective move, they'll make the next leg. So keep an eye out for that. But again, we've got a busy week ahead of us again next week. So with that said, this is the Forex Weekly Outlook for the week of June the 10th, 2009.